30 to beyond 30 centers.
All right, so that was the new Chief Executive Officer. You'll find that entire conversation on the website, and we'll play it out over the course of the day as well. But one important number to focus on is the kind of inflows into mid and small cap funds, as I was mentioning, and that is quite substantial. Over a third, in fact, of SIPs are flowing into these categories. But to talk about Mahindra Manulife, let me go to my guest today, Krishna. Krishna, thanks so much for taking the time. It's a good time to be a manager of the mid cap and small cap schemes, wouldn't you say?
Yeah, I agree. I mean, the times are good, and one just hopes to, get the fundamentals and valuation alignment as a fund manager part of it, because you've been in a situation right now where a lot of flows are coming, and I think as a market participant, it always makes sense to be aware whether is the flows which are driving fundamentals or the fundamentals driving the flows, and that's that connect of valuation, which perhaps links when valuations are in your favor, you believe that the fundamentals are driving the flows, and that's the right time to invest for people.
So one of the objectives of this show, and to bring representatives of the mutual fund industry into the studio and to speak to us and indeed to our viewers, is for you to communicate to them what your overarching principles are, what your strategy is. So as a fund house and in these two schemes, what is the principle that governs the selection of stocks?
Sure. So I think as a fund house, what we really believe is that India is in for a nice sweet spot on economic growth. For whatever our current rank, let's say we are 5th, we're likely to be number 3. On an average, I expect the economy to, let's say, double in next 7-8 years kind of time frame, maybe shorter. The broad idea is that, a lot of sectors are going to participate across time frame. What matters really is how we evaluate each of them in terms of their relative strength, in terms of valuations, and the earning power which each of these sectors can display over next maybe 12, 18, 24 months time frame. If you really look at a 5, 7, 10-year period, I guess it's reasonably smooth where a lot of sectors are going to grow. It's just the growth path may vary in terms of time frame, and so that's one focus. Let's look at relative growth across sectors. Every sector is investable is a broad thought process, because if economy is going to grow, everything is going to grow. There's nice linkage in economy which says that one sector's expense is other sector's income. So while one sector is spending right now, some other sector is benefiting as an income. So those guys grow much faster. At a later stage, the guy who's investing right now or who's spending money will start earning, and that's the time those people catch up. That's been one focus. Second focus really is to look at management quality across space, because in this sweet spot of growth, there are still some management which can deliver outstanding returns for the invested capital which they have. So that's the second part, and the third part really is a valuation track, because markets have a very nice way of rebalancing today's winners with maybe tomorrow's drags. They're not losers really, but in our markets, where if you underperform, it's a drag for some time. So idea is to look at valuation with this 12-18 month time frame, which helps normalizes valuation, while the growth in earnings anyway is a slightly longer term matter.
Okay. Now I want to delve a little deeper into these two funds. On the one hand, your mid cap fund has an AUM of close to around 1,950 crore rupees at the end of December. And your small cap fund has an AUM of just over 3,000 crore, 3,100 odd crore.
Yes.
Now, to delve a little deeper into the portfolio selection and the sectoral allocation, I see that there is no one sector that dominates. If anything, in your mid cap fund, what I was looking at is an even distribution between consumer cyclical, financial services, industrials. Each of these have 18% of AUM or thereabouts. And a similar theme plays out in your small cap as well. Basic materials, consumer cyclicals, 18% odd each. Financial services, about 15.5%. Industrials, about 15%. So you're sector agnostic seemingly. You don't drive on one sector. What is determining portfolio strategy?
I think portfolio construction, you're right. Clearly, when looks at, small cap, mid cap as a space, let's look at small cap first. Maybe we have 700 odd companies to invest in. Anything beyond first 250 is perhaps the primary investable universe. So one need not really worry too much about sectoral preference there. If you look from a philosophy and portfolio construct, I can possibly say there are 3 variables, which one says, what's the recovery in earnings? Because all these companies go through some sort of a tough patch or a smooth patch, and that's where better to understand normalized earnings and when that recovery happens for those companies. Second is a little bit of re-rating of valuations, because there are factors, maybe globally, maybe locally, which connect with valuations over and above the company-specific variables. And third part really is realignment of sectoral priorities, which the economy faces at any point of time. So if you look at these three factors: recovery in earnings, re-rating of valuations, and realignment of sectoral priorities, it somewhere helps to connect. At the same time, yes, there are underlying strengths of some of these companies which basically matter far more for their own company-specific growth. And I think that's a broad philosophy on portfolio construct.
Interesting. And I'm also looking at the size of the portfolio, and you'll have to help me understand, because these are relatively, especially your small cap fund, I believe, is only about a year, right?
Yeah.
So help me understand the kind of size that you're comfortable with. Is this the sweet spot for you? I'm looking at 74 odd stocks, and you'll have to tell me if that changed in December, but 74 odd stocks in the small cap fund and about 68 stocks in the mid cap fund. Now, you've seen some of your peers widen the basket very substantially because of the kind of inflows that have come in. But because you are relatively nimble in terms of the assets under management, you're, I think, able to keep the holdings to within that basket that you're comfortable with. Is that a fair assessment?
Yeah, that is a fair assessment, in the sense that, we do believe that, size and scale might require a more diversification at a later date. At the same time, also the belief is, the way economy is growing, a lot of new companies are coming up. Some sectors or some stocks were not available for, listed company participation. Those are coming up. So it's going to be, a combination of both. One is the size of our own AUM. Other is the sheer opportunity, new companies coming up in the market, which historically were not, let's say, investable. So broadly comfortable with these numbers. And I guess, some of these size issues are partly a function of how the overall market cap grows. We've seen right in front of us, maybe a couple of years back, the small cap cutoff would have been 12,000 odd crores. Today is maybe 21,000 crores. So if the average size of the market moves up, or the 250th stock in the market moves up by nearly 70-80%, even the AUM, obviously can be scaled up to far higher level of asset from a management perspective.
So a detractor, maybe somebody who's going to be very critical in viewing your performance, will say, look, they've been able to do this because they have the ability to do so. They're nimble. There are a few other people that are sitting on 15,000, 20,000, 30,000 crore AUM, and they don't have the bandwidth to be as selective. They have to necessarily move beyond, because of liquidity issues, beyond the stocks that they're comfortable with. Is that something that you agree with, or do you think that this kind of an outperformance is possible even with a doubling of AUM?
I guess, ability to manage money at maybe double the current size is not a challenge. As I clearly mentioned, part of the equation lies in how the markets have moved. If the average size of equity AUM still remains 12,000 crores, the equity small cap remains, let's say, 12,000 crores as cutoff, then possibly answer is no. But if the economy is growing, companies are growing, and by default, the base keeps on shifting up. So one really believes, that matters. In fact, that to my mind will be one of the biggest factor which can, arrive at some sort of a range for which AUM is possibly manageable or not manageable. I think that's the first part. Otherwise, broadly, the markets are large, liquid. At sometimes one may get an advantage, but beyond a point, it's the earnings of those companies which matters, how those management deliver on their business promises, and how markets value which matters. So to an extent, yes, we do believe, our AUMs are scalable for a reasonably higher, size of AUM. And as I said, it's always linked to the size of that 250th onwards, market cap.
Fantastic. So I have a couple more questions. One is the fact that a few of your bets have done incredibly well. So if you talk about the PSU investments that you've done, you've got REC, Coal India, and a few others, sizable bets on this, and this is outsized gain. So anybody that has done that in the mutual fund industry, in the actively managed space, has done incredibly well. What was the thinking behind that?
Yeah, in fact, very fact, the two names you use really are perhaps one of the most large and liquid names one can think of, right? So I think the previous point we discussed perhaps, is
elucidates that point.
But I think, so I mentioned three things, right? Beginning, recovery in earnings, re-rating on valuations, and realignment with the country's priority in terms of sectoral needs. So if we figure in this, and maybe power sector comes top of the mind because we realize suddenly that the amount of money India has to invest in next 4-5 years on power sector is significantly larger. So you need somebody to finance those power projects. You have reasonable amount of shortage on coal, and thermal power plants are the way to solve some of those issues of peak supply of power. So you have those companies. I think the core issue remains that that's a need of the sectoral need for the economy is power. Power financing. Without that, it's not much happen. Now, some of these companies, when they have a long gestation period, the benefits are more in the order book or maybe so-called undisbursed sanctions kind of thing as far as the financing companies are concerned. So that's where broadly I think it ties up those couple of names. Yeah.
Fantastic. So last thought here, and this is something that I give as an opportunity to every fund manager / CIO that comes under the program, is to give our viewers a bit of an outlook in terms of what they should expect, or maybe even a cautionary note sometimes. So heading into 2024, what's your message to your investor?
Yeah, sure. I think the broad message is simple. Markets in Indian context have kept on doing well over time. If you look at last 10 years, 15 years, 20 years, almost every sector has grown. Companies with a good quality management have delivered. Some companies have buckled because of management quality, but not because of economy. So as long as the management quality is right, we are in a sweet spot. As far as the other side of the market is concerned, which is a large cap, mid cap, small cap, there is a nice link says that every large cap company will have some small cap company as a customer or a vendor. Because the ecosystem among them is so nicely built. You are either a supplier to a large cap company or you are a customer of a large cap company, depending on the products. Our estimate is that profit pool participation keeps on shifting based on how economy moves, how the underlying pricing of raw material moves. So a classic example, when interest rates are high, the profit pool participation goes to banks. When interest rates are low, the small cap companies typically benefit far more because they have to pay less interest vis-a-vis what they were paying in the past. So I think some of those economic variables will determine coming to very near term, maybe next 6-12 months. Let's be aware that we had a great year on small cap, mid cap as a investor class. The challenge is always difficult in realizing whether this kind of returns are a capture of next 1 or 2 years or only just a catch up of last 1 year, and that's a little bit challenging. But as long as we clear that we're investing for that 3 and 5 years down the line, what our economy is going to grow, I think the times are good for all of us.
Fantastic. Thank you so much, Krishna, for joining us in the studio. Pleasure speaking with you.
Thanks, Alex.
Viewers, do stay tuned. We've got advice specifically for what your strategy should be on mid cap and small cap lined up just after this break. Welcome back. You're watching the Mutual Fund Show. To understand how to read the performance of Mahindra Manulife, and also to give you some outlook on how to approach mid-cap and small-cap investing. I'm joined by Prableen Bajpai as well as Santosh Joseph. Thank you so much to the both of you for joining in, and appreciate your patience in this. I will first come to you, Prableen, on what you make of the outperformance of Mahindra Manulife, and then I'll quickly get a view from Santosh as well. Prableen.
Good afternoon, Alex. And I was listening to your conversation with Mr. Sanghavi. Good insights there. Definitely, both these schemes have given spectacular returns, and it's hard to ignore toppers. Both of them followed a mix of growth and value together. Very, very efficient picking in terms of stocks and sectors. So broadly, 80% of the construct is, with a bottom-up approach, and 20% is, on the sectoral calls. So definitely they got their sectors right for them. PSUs, industrial capital goods, auto ancillaries, all of these have worked for them. And small AUMs, agile. And I think they've been holding a decent amount of cash as well to, capture on the opportunities that come along the way. So definitely, I think both of these schemes are, will be and should be on the radar of investors. But coming to the small cap first, Alex, it's just a year-old fund. And of course, the year has been phenomenal across the category. So we haven't seen the fund through a down phase yet. So I think that is something would be interesting, how the fund manager, because both the schemes are managed by the same set of fund managers. So it would be interesting how they are able to manage the funds during downturns. And coming to the mid cap, it has been there since 2018. And even during the corrections, it was able to beat the benchmark. Very few of the active funds are able to beat the benchmark. So even during the downturns, the mid cap managed to do that. So I think a great, selection process there. And so far, the convictions have proved right. And I think currently now they are overweight on capital goods and financial services. So let's see how that plays out in the coming year.
Santosh, anything to add? I pose this question to Krishna as well. The maneuverability of a smaller AUM has held them in good stead.
I think some of things have gone right for them, and I think you alluded to most of it. The size and the ability to get flows when your size is small and when you have a right portfolio is actually magic potion for a mid cap and small cap to do well. So here, case in point for the Manulife mid cap and small cap is that about a year and a half ago, when mid cap and small cap were not in favor, you had size going for them, they had liquidity, and you had flows coming in as performance started picking in. So that combination is made well. And I think we just heard the fund manager also speak. The beauty is that when you're flexible or nimble with the portfolio positioning, especially in a market like what we experienced in 2022 and 23, extremely choppy, and very few of us expected this kind of an outcome. I think he's just hit it outside the park, taken the most of the situation. It's like, you got good pitches and you got great pitches, and in a great pitch, how you make the most out of it.
Right. Going forward, though, how would you approach the space? I ask because I was looking at the AMFI numbers, guys, and 64,000 crore rupees of money inflows into mid-cap and small cap, mostly into small cap. How should the... And that doesn't stop. It's continued around that same trajectory. So there is a little bit of concern for people that are watching the space, right? I'm guessing advisors like yourself are advocating caution, but what specifically, Prableen, would you go into 2024 doing?
Alex, definitely money starts to chase returns. And in this case, both these segments have done phenomenally well, as I mentioned. I think going into 2024, what is important is we are still, a few months, elections are in mid of the year, and we may actually see a pre-election rally. We may see an interest rate cut during the year, which can again prove to be great for the mid and small cap space. So valuation wise, while we say that, if we look at the mid caps, they are already trading at, at 38% premium to the Nifty 50 as compared to the 3%, which is the historical average. And even the small caps are at a 10% premium as compared to a 23% discount, which is historically the figure. It's hard to say whether this rally would stop in the next, or there will be a huge correction. So I think with the shift that we are seeing from the unorganized sector to the organized sector, to the sectors which are actually totally absent from the large cap space and which are going to be beneficiaries of the economic development and more capex spending. I think these, the mid cap and the small cap can continue to see decent returns even in the coming year. But again, because we've seen this huge divergence in the valuation, which was, earlier in favor of the large caps in 2021, it has been reversed. So obviously the outlook is, being that we are cautious, and we don't want to chase returns. Having said that, with a long-term view, go in a staggered manner and continue to make your investments with a long-term view in mind. Don't expect, I think slightly lowered expectations would be the better way to approach these two mid caps and small cap segments.
Fantastic. I'm guessing, Santosh, you have a similar view, and if you can also tell us what funds you like in the space and how to approach strategically investing in them, whether or not rebalancing is required if there are outsized gains in your portfolio right now.
Yeah, so there are 2-3 parts to this. Number one is when you look at the way the mid cap and small caps have performed on a 1 year, 5 year, 10 year basis, all of them are done phenomenally well. Now, when you look at that kind of data and when you look at investing for fresh, that's when you get a little confused. That is, should I take the mid cap call right now, or have I missed the whole rally and now it doesn't make sense? So I think the way to approach that is, if you are investing mid cap and small cap and you're beginning as a new investor today, I think you tone down the expectation, number one, and number two, exposure that you get into. For example, a year ago or maybe a year and a half ago, if you would 30-40% of your portfolio could have been in mid and small cap, today maybe you will cut to 50% of that. The reason is bulk of the returns have been front-ended over the last year, year and a half, and in future, the numbers are just not so favorable for you. Not saying that we will not perform, but at some level, this performance is going to get plateaued out, number one. Number two, very, very critical. We're not talking about any particular stock or any particular sector when it comes to small and mid caps particularly. We're talking about good, well-managed funds. So therefore, in a good, well-managed fund like the one that we just discussed a little earlier, you have the luxury of the fund manager deciding sectoral view, value versus growth, number of stocks, within that also the weightages in the particular stocks. So therefore, that's where it becomes very important. So some of the names that I'm personally a little favorite of is, I'd look at a White Oak mid-cap fund where they're not allowing lump sum investments to come in. If you look at the DSP mid-cap, a 17-year-old track record fund, extremely consistent. Motilal Oswal mid-cap. Now, if I were to look at building my portfolio with these mid-cap funds, the beauty is that all of them have unique positioning and unique stocks. Now, of course, there is a small bit of overlap, but as an investor, you get different styles, different stocks, and different weightages playing for you. So the debate is not about should I or should I not. The debate is what is the percentage that you enter, and also what is the mix you get between different styles and portfolio managers.
Right. Got it. Prableen, last word, very quick. 30 seconds. Which funds do you like?
I would say Tata Small Cap and Mirai Mid Cap. And I really like the passive strategy, Alex. But again, one has to be very cautious with the passive strategy at this stage because, that is what would take a harder hit. There is too much of elasticity in the mid and small cap space. So the, highs and the lows are much sharper. So very long-term portfolio, go with passives. And I think in the medium to, slightly long-term, I would consider Tata and Mirai. And overall, take a staggered approach and, continue with the investments, but definitely lower the allocations that you are giving towards these two market caps.
Fantastic. Thank you so much, Prableen, as well as Santosh, for joining in and giving your advice to our viewers. Viewers, that brings us to the end of this particular edition of the Mutual Fund Show, but there's lots lined up over the course of the day. You'll find all of that right here on NDTV Profit.